Alex built a dividend portfolio paying 10% a year. Every month, checks hitting his account. It felt like financial freedom. 2 years later, he was $57,000 behind someone who did nothing but buy an index fund. This is the dividend trap, and most investors never see it coming. Today, I'm going to show you 3 things. First, why dividend investing feels so good but quietly destroys your returns. Second, the hidden math that most dividend investors never look at. Third, what Alex finally did differently and how he stopped falling behind the market. And by the end of this video, you'll know exactly whether dividends belong in your portfolio or not. Let's start with Alex. Alex discovered dividend investing 2 years ago, and it completely changed how he thought about money. He loved the idea of getting paid just for owning stocks, passive income, monthly checks, financial freedom. So he built a portfolio of high dividend stocks, some paying 8%, some paying 10%, even a few paying 12%. Every month, money hit his account without him doing anything. It felt incredible. You might be thinking, that sounds pretty good actually. And that's exactly what makes this trap so dangerous. Because here's what Alex didn't realize. While he was collecting those dividend checks, his actual portfolio was barely growing. Over 2 years, his total return was around 6% per year. Meanwhile, a simple S&P 500 index fund returned about 12% over the same period. Same 2 years, same starting amount, half the return. Alex was working harder at investing than anyone he knew and getting paid less for it. Now let's understand exactly why this happens, because the math here is something most people never get taught. Think of it like this. Imagine you have a glass of water sitting on a table. You pour some water out into a cup beside it. Did you create new water? No, you just moved it from one container to another. That's exactly what a dividend does. When a company pays you a dividend, it doesn't create new money. That money comes directly out of the company's value. Here's the real number. A stock is worth $100 per share. The company pays a $5 dividend. The very next day, the stock drops to $95. You received $5, but your share is worth $5 less. Your total position is exactly the same as before the dividend was paid. Nothing was gained. The money just moved. This is called the dividend irrelevance theory, and it's one of the most important concepts in investing that almost nobody talks about. Now, I need to be honest with you for a second. This doesn't mean dividends are completely worthless, but it does mean that a high dividend yield alone is not a sign of a good investment. In fact, a very high dividend yield is sometimes actually a warning sign. Here's why. You might be thinking, a 12% yield sounds amazing, but here's what's really happening. When a company's stock price falls, the dividend yield automatically goes up. So that 12% yield might exist because the stock price already dropped significantly. You're not getting a great deal. You're buying a struggling company. This is called a dividend yield trap, and it catches thousands of investors every single year. Now let's talk about something that makes this even worse: taxes. When Alex receives a dividend payment, the IRS treats it as income. He pays tax on it that same year, whether he wanted the money or not. With a growth stock or an index fund, you only pay tax when you choose to sell. That means you control when you get taxed. Dividends take that control away from you. Think of it like this. Imagine your employer pays you your entire year's salary in January instead of monthly. Your tax bill arrives much earlier than you planned, and you lose months of compounding on that money. That's what dividends do to your portfolio every single year. Over 10 or 20 years, that difference in tax timing can cost you tens of thousands of dollars. Money that could have been compounding in your account goes to the government ahead of schedule. Now let's get back to Alex. After 2 years of chasing dividends, Alex finally ran the numbers side by side, and what he found stopped him cold. He compared his dividend portfolio against a simple S&P 500 index fund over a 10-year period. His dividend stocks averaged around 7% total return per year. The index fund averaged around 12% per year. On a $50,000 starting investment, that difference is massive. At 7% over 10 years, Alex would have around $98,000. At 12% over 10 years, Alex would have around $155,000. Same starting amount, same 10 years, a $57,000 difference, just from choosing the wrong type of investment. Now, here's where it gets really interesting, because Alex didn't panic. He didn't give up on investing entirely. He just changed his strategy. He moved the majority of his portfolio into a low-cost S&P 500 index fund, and for the portion where he genuinely wanted income, he used a different approach. Instead of waiting for dividend payments, he sold a small percentage of his index fund each year. This is called a systematic withdrawal strategy, and here's why it's more powerful than waiting for dividends. You might be thinking, isn't that the same thing? It's not, and here's the difference. With dividends, the company decides when to pay you, how much, and you get taxed immediately. With a systematic withdrawal, Alex decides when to take money, how much he needs, and he controls exactly when the tax event happens. He's in control, not the company, not the dividend schedule. Now, I want to address something important because dividend investors always make one argument at this point. They say, but dividends are reliable. Companies keep paying even when the market drops. And that's partially true. But here's what that argument misses. During the 2008 financial crisis, over 60% of dividend-paying companies either cut or completely eliminated their dividends. During COVID in 2020, hundreds of well-known dividend stocks suspended payments entirely. The income that felt safe and reliable disappeared exactly when people needed it most. An S&P 500 index fund dropped in value during those same periods, but it recovered. It kept compounding, and Alex was in control of his own withdrawals the entire time. Now, here's the honest answer most finance videos never give you. Dividend stocks absolutely have a place in a portfolio, particularly for retirees who need regular income and want simplicity. If Alex is 65 and wants monthly income without thinking about selling shares, dividend stocks make real sense. But if Alex is in his 20s, 30s, or 40s, and his goal is to build the largest possible portfolio over time, chasing high dividend yields is likely costing him returns. The math is clear. Total return beats dividend income almost every single time over long periods. Here's what actually works. Build wealth first using low-cost index funds that maximize total return. Then, when you actually need income, create your own dividend through systematic withdrawals. You get the same monthly income, you pay less in taxes, and you keep more control over your own money. Here's the hard truth. Dividends feel good. Getting paid to hold a stock feels like winning. But investing isn't about what feels good. It's about what actually builds wealth. Alex spent 2 years collecting dividend checks and fell behind the market by nearly 6% per year. Then he ran the numbers, changed his strategy, and gave his money the best possible chance to grow. The dividend trap isn't about greed. It's about focusing on the wrong number. High yield feels like income, but total return is what actually builds your future. Now you know the difference. Are you currently investing in dividend stocks, or have you already made the switch to index funds? Let me know in the comments, and subscribe if you want more videos like this. See you next time.